Welcome back to the Deep Dive. This is where we break down the most complex financial reports to pull out the insights that, you can actually use.
And today, we are really cracking open a big one. It's the Monday, December 1st, 2025 U.S. Market Close edition of the Reserve of KING-KAMBUF Financial News and Reports Magazine Weekly Market Digest and Investment Analysis.
Specifically, the daily report.
That's right, the daily report. And this one gives us a fascinating roadmap of investor intent. It captures a session that was it was defined by a massive reversal.
Yeah, a real paradox to kick off December. You had all the major indices, the Dow, S&P 500, Nasdaq, they all opened on the back foot.
Right. It looked like it was set for a pretty deep profit-taking pullback. The S&P 500 slipped, a full 0.5% right at the start?
In that opening volatility, that naturally creates a sense of apprehension. If you were watching your screen at 9:30 a.m., the mood was definitely risk-off.
For sure. But the real story, the critical narrative of the day, is the strength we saw by the closing bell.
The market completely flipped the script. It finished higher across all three majors.
And that kind of reversal, that signals an incredibly robust, kind of persistent institutional demand. It's a clear return to positive risk sentiment.
So the question is, what fueled that turn? And maybe more importantly for you listening, how do we translate that volatile movement into tactical execution?
Well, that's our mission for this deep dive. It's to synthesize the macro environment with all that micro action and then extract the high detail, process-based tactical guidance that lines up directly with your TKIF trading framework for the rest of the week.
Okay, let's define our terms really quickly here because we're going to be using it a lot. For anyone less familiar, the TKIF system, what is it?
It's a highly disciplined proprietary framework, and it's focused on capturing short-term range expansions, so usually holding assets for maybe 48 to 72 hours.
And it uses strictly predefined risk-reward ratios.
Exactly. It's often centered around a hard 1% stop and a 1.5% target. It really thrives on volatility and, predictable range movements.
Which makes Monday's data absolute gold.
It's the perfect setup. But we do have a necessary technical note here regarding the data you shared with us.
Right.
We have to address this limitation up front. The specific proprietary TKIF PDF files, the ones with your exact calculated stock trading ranges, your targets, and projected spreads, we actually couldn't access or parse those specialized documents.
Yeah, and we want to assure you, this doesn't diminish the analysis.
Yeah.
Actually, it kind of sharpens our focus.
It does. Instead of trying to confirm numbers that you already have, we're going to focus entirely on process-based guidance.
So we'll use public market data proxies. The high volatility, high liquidity tickers that publicly mirror the TKIF logic to define the ideal entry conditions and risk profiles.
And that approach lets you cross-reference what we're talking about with your own local TKIF sheets. It makes sure you maintain adherence to your system's discipline without needing us to verify specific price points.
Think of it like this. We're defining the target-rich environment.
Exactly. We identify the where and the when, and you apply the how much from your local proprietary calculation.
Okay, let's unpack this strong reversal, starting with the broad market indicators that really set the mood for the rest of the week. #1, Market Watch, the reversal and macro dashboard. So when you see a session open soft like that, the market is usually showing some nerves. But the VIX, the market's so-called fear gauge, it seemed to tell a bit of a different story.
A very different story.
What was the VIX telling us on December 1st?
Well, the VIX, the CBOE Volatility Index, was it was relatively subdued. It settled at 16.35 by the close.
Which was actually down a bit.
Yeah, a slight drop from 17.21 just a few days prior. Now, we all know the long-term average for the VIX is closer to, 19 or 20?
Right.
A reading of 16.35 is about 0.4 standard deviations below that historical average.
So even with that rocky morning, the professional money managers, they weren't exactly running out to buy protection en masse.
Not at all. If the VIX represents the market's expectation of 30-day volatility, 16.35 signals, well, a condition we can best describe as constrained neutrality.
Constrained neutrality. I like that. So not panic.
Definitely not panic. That would be a VIX of 25 or higher. And it's certainly not complacency, which would be a VIX, below 12.
So what does that level tell us?
It tells institutional players that the overall structural risk is manageable and they're comfortable holding their positions. For a short-term trading system like TKIF, this is actually pretty favorable.
Because it suggests movements will be contained within defined ranges.
Precisely. Rather than being subject to just extreme wild gap shocks. Though we do have to talk about concentration risk later on.
Okay, let's drill down into the index level snapshot because this is where that reversal really becomes tangible. Where did the indices ultimately land after fighting off that early pressure?
The recovery was decisive. The Dow Jones Industrial Average, the DJIA, it closed near the upper bound of its recent trading channel.
And that channel was oscillating between about 47,000 and 47,000 in late November, right?
That's the one. The final level, around 47,716, confirmed a break toward the upside. It indicates really robust demand in those high-priced industrial and financial components.
And the broader market measure, the S&P 500, that's really the critical one for overall market health.
The S&P 500 traded around 6,812. It managed to completely erase that initial 0.5% dip and finish in the green.
The psychological takeaway there is just enormous.
It really is. Traders tested support early in the session, they found a strong bid, and then they just chased that bid higher all day. It confirms that the underlying positive momentum, the one driven by the mega-cap names, is still fully intact.
Despite these minor profit-taking attempts.
Exactly. And the Nasdaq composite, unsurprisingly given the sector leadership we're about to discuss, showed similar resilience. It held that 23,300 to 23,400 region.
The critical element here, though, was the strong close, near session highs. This wasn't just passive buying.
No, this was an aggressive push. And it was specifically driven by two interconnected factors that tend to define that end-of-day momentum.
Okay, what are those? What typically drives that institutional dash to the close?
First, it's the performance of mega-cap technology. As we'll see, their weighting is just so high that even moderate buying pushes the entire index up substantially.
Okay, that makes sense.
And second, and this is really key for that end-of-day move, we saw slightly softer long-end yields in the bond market.
So when the yields on longer-dated treasury bonds ease up, it makes high-growth stocks look more attractive.
Structurally more valuable, yeah. High-duration assets like high-growth tech and software stocks. This institutional dynamic, it often kicks in really strongly in the final hours of trading, as funds are locking in their positioning for the overnight period based on that rate environment.
So the softer yields gave them the technical excuse, and the liquidity just flowed immediately into the AI and cloud leaders, erasing the morning's weakness.
That's the playbook.
So let's broaden the view. What are the sort of three enduring macro themes that are driving this whole tape into December?
The market narrative is always balancing between three massive anchors. The first one is just. It's the necessary pullback after the powerful 2025 advance.
Right, we've had such a phenomenal, almost parabolic run fueled by AI.
Exactly. So profit-taking is a natural and healthy part of the cycle. Investors are constantly trying to position for that next leg up.
And that relates directly to the second major theme, which is all about interest rate sensitivity.
Absolutely. The second theme is the intense focus on the timing and pace of future Federal Reserve cuts. I mean, since the Fed has indicated it's monitoring inflation, every single piece of economic data is just maniacally scrutinized.
So if the data looks weak, the market thinks, great, cuts are coming sooner, and stocks go up.
Right. And if the data looks too strong, the cuts get delayed and stocks sell off. It's a real tightrope walk.
And the third theme, the enduring force that defines all the volatility we're looking for.
That is the continuing and relentless rotation into AI-levered names. This is the structural driver of performance. We're talking chip manufacturers, cloud infrastructure providers, specialized software companies.
And when risk sentiment is positive,
money just flows disproportionately into these core leaders because they represent the highest growth potential in this economic cycle. This momentum is the engine that generates the ranges TQIF is designed to trade.
It's all about concentration, which brings us perfectly to the structural anomaly that's defining this market.
If we were talking about a market from, say, 20 years ago, we would expect index moves to reflect broad economic participation.
That's not today's market.
Not at all. Today, the structural reality is defined by extreme concentration. We just can't analyze market movement without understanding where the capital is actually sitting.
The numbers detailing the S&P 500 dominance in the KMBU report are just. They're truly staggering. We're talking about a structural phenomenon that hasn't been this severe since the dot-com bubble.
Exactly. I mean, look at the data on sector weighting. Information technology is now overwhelmingly dominant. It accounts for over 31% to 35% of the S&P 500's total market cap.
Just to put that in context.
To put that in historical context, that percentage is more than double the share the sector held just a decade ago. It reflects a profound, rapid shift in perceived economic value.
But the concentration goes even deeper than just the sector level, right? It's not just IT. It's a handful of names within that sector.
That is the critical insight. This is a top-heavy structure that is levered to an incredibly small group. The largest 10 constituents, the familiar Magnificent Seven style names, they now account for nearly 40% of the entire S&P 500 market cap.
40%.
40%, which means if just one or two of those 10 stocks have a major news event or a material earnings surprise, the entire index moves violently, regardless of what the other 490 companies are doing.
And the report specifically highlights the volatility contribution, which should honestly send shivers down the spine of anyone who thinks they're relying on broad diversification.
It should. The data shows that information technology contributes nearly half of the forecast volatility for the S&P 500.
Half.
Half. And this is the paradox we talked about earlier. The VIX is low, suggesting stability, but the index itself is structurally highly leveraged. If those 10 megacap stocks are trading in a tight range, the VIX is low. But if they suffer a coordinated shock like an unexpected regulatory crackdown or an AI bubble reversal, the index would see volatility spike to unprecedented levels because that leverage is just so high.
Let's use the specific sector breakdown provided in the report to really solidify this imbalance.
Right.
Looking at the mid-2025 weights, IT is the elephant in the room.
A huge elephant. IT sits at 31.6%. The sectors after that are dramatically smaller.
Like financials?
Right. You have financials at 14.3%, which reflects the stable banking and insurance sectors. Then comes consumer discretionary at 10.6%.
And that includes names like Amazon and Tesla.
The cyclical, growth-oriented consumer stocks, exactly. And finally, communication services at 9.6%, which is home to the major internet and media giants.
When you add those top four sectors up, you realize over 65% of the S&P 500's movement is determined by just those clusters.
Precisely. And that explains why certain indices are perpetually high-flying in bull markets. The Nasdaq 100 is the ultimate reflection of this concentration.
Because it's even more skewed towards tech.
It excludes financials and is heavily skewed toward tech, so the weight of technology alone often exceeds 60%. Consumer discretionary adds another huge slice. The sources show the return gap. The Nasdaq 100 returned roughly, 13.08% from 2007 to 2025 compared to 543% for the S&P 500.
That's the reward for concentration.
It is, but it also comes with a corresponding increase in systemic risk and annualized volatility, which is the perfect engine for a system like KING-KAMBUF.
Now, we have to differentiate this from the third major index, the Dow Jones Industrial Average. It's often used as a bellwether, but its weighting methodology is, it's archaic.
It really is an anomaly. The Dow is price-weighted. It ignores market capitalization completely.
So the absolute dollar price of a single share determines that stock's influence.
That's right. Which means a high-flying, smaller cap company that happens to have a high share price could move the Dow more than a massive, stable corporation with a low share price. It's a strange system.
So who are the key influencers then? Who has that pricing power in the Dow?
The top three weights are heavily skewed towards high-dollar, large-cap names, but the driver is the share price itself. So Goldman Sachs, GS, sits at the top. It represents about 10.5% of the Dow's movement. Then you have the industrial titan Caterpillar, CAT, at around 7.4%. And then the tech giant Microsoft, MSFT, at about 6.3%.
So a relatively minor news event causing a $5 move in Goldman Sachs will have a much bigger impact on the Dow's point total than a major earnings surprise that moves a lower-priced stock, like Verizon, by the same $5.
A vastly greater impact. The implication for us as tactical traders is crystal clear.
When the Dow is strong, you need to immediately look at whether financials and industrials, the highest price-weighted sectors, are performing, not just assume broad market strength.
That's the takeaway. The index movement is narrow. When the VIX is low, it's because institutions are betting heavily and confidently on the performance of a dozen highly liquid, highly weighted names. But this structural confidence, it masks the chaos happening in the rest of the market.
Which is exactly where a system like TKI should be looking.
Oh.
Okay, so now we leave the relative safety of the institutional names and we dive into the true high beta lottery tickets.
The fun stuff.
The names that provide that explosive high-range movement that allows the system focused on 1.5% targets to hit its goal really, really rapidly. And the pre-market action on December 1st was just sensational.
It provided classic signals for range expansion. We saw massive gaps signaling major news or just extreme speculative interest, and they were consistent with the eventual volume leaders. Let's look at two incredible examples in the biotech and microcap space.
Let's start with QTTB. That's Q32 Bio.
QTTB was a textbook gap runner. It was up roughly, 95% or more before the market even opened. And by the end of the regular session, it had extended that gain to a staggering 146% on tremendous volume, about 123 million shares traded.
And that volume confirmation, following a gap like that, tells you the move has staying power.
It does. It's fueled by retail speculation and, of course, short covering.
And then the leader, AHMA, Ambition's Enterprise Management, which pushed beyond the 200% threshold.
AHMA's movement was truly exceptional. Its pre-market jump pushed above plus 120%, and it maintained that momentum, extending to a mind-blowing 235% gain on the session, closing around $16.15.
These names are just the perfect storm for range-based trading.
They are. Low float, sudden positive headlines, massive retail engagement. They generate huge spreads in intraday ranges that can just swallow and exceed the TKIF 1.5% target multiple times over.
We also track some option-implied volatility spikes. So why is watching these IV in play candidates relevant for an equity trader who's focused on TKIF?
Well, option-implied volatility. It's essentially the market's expectation of future volatility. So when AV spikes dramatically in names like CYTK, ARWR, BIOTO, INTC, SLV, SLJ, and HYMC.
A pretty diverse list.
It is. But it signals that traders are anticipating a major price move due to news, earnings, or major institutional positioning.
So even if you aren't trading the options themselves.
Exactly. Even then, these high AV names should be prioritized on your TKIF watch list because they are primed for sudden range expansion. They are high probability, high range candidates for that short holding period.
Let's pivot to the volume data. This extreme skew towards speculative microcaps dominating the volume lists. That's a critical insight for the range trader.
It fundamentally redefines active trading. The most active stock by share volume on December 1st was DRCT, Direct Digital Holdings. It traded an astonishing 282 million shares.
282 million shares.
And this stock is a classic low-priced vehicle. It's often targeted by algorithmic and retail volume, and it finished up about 8.25%.
That's more than 3 times the volume traded by a powerhouse like NVIDIA. What does that tell us about where the true liquidity is?
It tells us that liquidity is bifurcated. There's deep, clean liquidity in the megacaps, for sure. But the chaotic liquidity, the kind that facilitates massive short-term ranges, is concentrated in these low-priced vehicles.
And you see this huge divergence in performance.
A massive one. We had QTTB trading 152 million shares on its 146% gain. But on the flip side, we saw PAVS, Paranovus Entertainment Technology, which traded about 138 million shares.
And it just cratered.
It plummeted over 72% on the day, closing near 28 cents.
A stock down 72%, but trading 138 million shares. That confirms that price discovery is just violent.
It's absolute chaos. That combination of high volume and extreme range, a 72% loss, means the supply-demand imbalance was acute. It generated the volatile spreads and range expansion that TKIF is built to exploit. It confirms the ideal conditions existed far away from the concentrated S&P 500.
Let's quickly look at the 52-week highs and lows to anchor our focus on some broader trends. Who's showing trend continuation?
The new highs list points to structural strength in resilient sectors. We saw defensive retail hitting highs with Walmart, WMT, around $111 to $112, confirming consumer staple strength. And growth in specialized areas also broke out. Travel and gaming with Las Vegas Sands, LVS Specialty Materials via Albemarle, ALB, and FinTech with New Holdings, NU, hitting highs near 17.56, driven by heavy volume and recent analyst upgrades.
So these are high-quality trend names that tend to respect TKIF entry logic when you're buying pullbacks.
They do. And on the weakness side, the names approaching 52-week lows included several software and infrastructure plays, MSTR, CPRT, NTNX, and TU.
Which signals persistent weakness in those specific pockets, even as the indices push higher.
Right. For the TKIF trader, these names offer potential short setups or, high-risk mean reversion long setups, but the underlying trend is clearly against them.
So the ultimate takeaway from this section is that the big index reversal on December 1st only tells half the story. The real edge is in identifying these highly volatile, volume-driven microcaps and applying the TKIF framework to their extraordinary intraday ranges.
Exactly. You use the strength of the indices to validate the overall risk-on sentiment, and then you apply your tactical system to the names that actually deliver the necessary volatility.
So now let's look ahead. What volatility triggers are guaranteed for the rest of the week? Forward focus is everything for a short-term range trading system. We need to identify those guaranteed volatility pockets that are going to drive range expansion right into the TKIF sweet spot, Tuesday and Wednesday's trading sessions.
That's right. Monday's trading may be done, but the post-close earnings from that day already set the stage for Tuesday. The reports released after the close of the December 1st session immediately created some sectoral volatility.
The biggest news came from the cloud and data infrastructure space, right?
It did. MongoDB, MDB, was the headliner.
Tell us about that surprise.
MDB, the database platform, delivered a massive upside surprise that just crushed expectations. They reported EPS of $1.32 versus a consensus estimate of only 26 cents.
Wow, that's an exponential beat.
It is. And revenue also sailed past estimates, coming in at $628 million versus $593 million expected. The shares reacted immediately and traded sharply higher after hours, cementing that bullish sentiment for the broader cloud software ecosystem.
What's the implication of a beat of that magnitude from a name like MDB?
It provides immense confidence in the demand for scalable data infrastructure, particularly in that AI layer. It tells the market that enterprise spending on core data tools is still robust, even if overall growth concerns persist.
And this positive read-through immediately puts upward pressure on every comparable company in that data stack.
You got it. And there were other significant beats that reinforce this theme.
Like who?
Credo Technology Group, CRDO. They also performed strongly, beating expectations on both the top and bottom lines, posting EPS of 67 cents versus 42 expected. This reinforces the strength in specialized hardware and connectivity chips crucial for hyperscale data centers.
Okay, so a pretty strong theme.
A very strong theme. We saw mixed results from Vestas, VSTS, but the overriding theme from Monday night was undeniable strength in enterprise cloud and AI infrastructure.
Which means Tuesday's session is likely to see follow-through buying pressure in those related sectors. So let's map out the critical calendar for the rest of the week, December 1st through 5th.
Okay, we need to zero in on the reports that are guaranteed to generate the kind of range that TKIF seeks. The focus really shifts midweek.
Wednesday is just loaded with software and AI plays.
Absolutely. Wednesday is your major volatility trigger point. We get Salesforce CRM, which is a critical bellwether. It's giving a Q3 FY 2026 update on their cloud platform and, crucially, their monetization of recent AI integrations.
And alongside CRM, we have the high beta AI software pure plays.
That's right, Snowflake, SNOW, the data cloud giant, and C3.ai, Symbol AI, which is one of the highest beta, most speculative software names tied directly to the AI theme.
Those three names, CRM, SNOW, and AI, they could easily move the Nasdaq alone by 1% in either direction based on their results.
Oh, they absolutely will create a massive volatility pocket. If CRM confirms MDB's bullish outlook, we'll see a surge. If C3.ai misses guidance, the entire speculative software space will face heavy profit-taking.
This guarantees the necessary range expansion for the TKIF entries on Tuesday or Wednesday.
Guaranteed. And then Thursday, the focus shifts a bit to the consumer, which provides a different kind of volatility.
So on Thursday, we look at the health of the American consumer, particularly that lower to middle income segment, through Dollar General DG.
Yep. As a discount retail bellwether, DG's same-store sales and inventory commentary are vital. We also get Kroger, KR. Any sign of consumer stress here will lead to volatility that spreads through the consumer staples and discretionary sectors.
So connecting this back to the TKIF rulebook, why do these specific earnings candidates, rather than others, make the cut for range trading?
Because they fit that high volatility profile. Software, data infrastructure, and discount retail are known for elevated post-earnings volatility. They often gap by 5 to 15%.
And that rapid, news-driven expansion of the trading range is just ideal for setting up a TKIF trade.
It's perfect. You enter near the post-earnings, high or low, you use the momentum to get that 1.5% target quickly, and then you get out before the mean reversion fully sets in. These calendar events guarantee action within your preferred short holding window.
Okay, we're now at the most critical section of this deep dive, the tactical application.
Yeah.
And since we can't use your exact numbers, we have to define this conceptual TKIF trade idea grid based on high probability entry criteria using the generic risk parameters of a minus 1% hard stop and a plus 1.5% target. Right. This is a guide to the process, not a recommendation of specific prices. We're defining the types of entries that work best for these names. So first, a quick recap of the standard TKIF rules for this weekly cycle.
Correct. The core rules are your anchor. The entry window is Tuesday morning, following the Monday close action and after-hours earnings.
Exit is Wednesday afternoon, or when the plus 1.5% target where the -1% hard stop is hit.
And remember, this structure demands small size and just relentless discipline. Hashtag tag 5.1 large cap AI momentum candidates.
All right, let's start with the highest quality names, the ones with the tightest spreads, lowest slippage risk, where the institutional money is really concentrated.
Number 1, NVIDIA. NVDA. This is a firmly long bias. It's the core engine of the entire AI flow. Your entry plan should target a buy zone near the volume-weighted average price, or VWAP, for Monday's strong session.
Let's just quickly define VWAP here since we haven't used it formally yet.
Good idea. VWAP is the cumulative average of price, but weighted by volume. It's critical because institutions use it as a benchmark for their execution.
So an entry targeting Monday's VWAP, or maybe a retest of the 8-day exponential moving average.
Right, which should conceptually fall in the range of a shallow pullback. That gives you a high probability entry point that's supported by institutional demand. It's much better than just picking a random percentage drop.
Okay. Number 2, Microsoft. MSFT. The Cloud Plus AI platform.
Also a steady long bias. Your entry plan here should target a shallower dip, maybe looking for a retest of the prior day's high-volume node or that same 8-day EMA.
MSFT is less volatile than NVIDIA.
Less volatile, but it respects these technical levels very reliably, which offers stronger confirmation. And that stability lets you use a slightly larger size than you would on a pure high-beta name.
Number 3, Apple. AAPL. The services and hardware anchor.
Another steady long bias, but the entry plan here needs to wait for a deeper, more controlled pullback. I would look for the price to retest the 10-day simple moving average, the SMA.
Apple is slower, offers less rapid range expansion.
It does, but it's a good TKIF candidate when the market is risk-on because its immense liquidity minimizes slippage. And that is crucial when you're operating on a tight 1% stop.
Okay, number 4, Meta Platforms. Meta. High beta ad and AI story. This one requires extra caution.
Absolutely. Long bias, but with a heightened awareness of its inherent volatility, its whippiness. The entry plan should focus on dips into the 21-day EMA region. That's a more significant retracement zone.
And the rationale there.
Meta has a strong trend, but it frequently has these deep intraday shakeouts. You need to wait for a more meaningful pullback to establish a position that can withstand that expected volatility. Smaller size is mandatory here, and that stop must be managed meticulously. Hashtag tag 5.2, consumer, defensive, and high beta names.
All right, moving to names outside of pure tech that still offer excellent TKIF characteristics because of their volume and trend.
Number 5, Costco. Cost and upload. Defensive growth retail. Bias is long. The entry plan should target a retest of Monday's intraday VWAP or the 20-day SMA.
Costco is resilient. You don't want to chase gap ups.
Never. You are waiting for the institutional selling pressure to exhaust itself near a technically supported level before you initiate the trade.
Okay. Number 6, Amazon. AMZN. The e-commerce and cloud hybrid. A blend of tech and consumer exposure.
Long bias. Your buy area should be near a clear short-term support level, something like the previous week's high or a key Fibonacci level that correlates with a shallow retest.
And Amazon is exceptional because of that double-barreled exposure.
Exactly. It gets the strong cloud demand from AWS and the positive consumer narrative from that Walmart new high noon.
Okay. Number 7, T-Mobile US, TMUS. The steadier telecom grinder.
Long bias. This stock is less prone to wild swings, which makes it a really reliable grinder for that Monday to Wednesday window. The entry plan is simple. Target a mild dip near the prior session's low volume node.
And its lower volatility means you can use slightly larger position sizing.
You can, but patience for that plus 1.5% target will be key. It's a grinder.
Number 8, Tesla, TSLA. The highest beta autoplay, prone to headline risk.
This one has to be strictly a tactical long only. The entry plan requires strict intraday confirmation. Entry should only be considered if the stock reclaims and holds above the prior session's closing price, and that needs to be confirmed by rising volume after an initial dip.
TSLA can deliver 1.5% in minutes.
In both directions, it can just as easily hit the minus 1% stop just as fast. This name requires the smallest position size and total obedience to the stop. You are trading price action here, not fundamentals.
And number 9, Deere, DE Industrial and Ag Tech Anchor.
Long bias. It provides crucial diversification outside of pure tech. The buy zone should target the daily support level or the 20-day EMA. DE is a quality trend name that participates when growth sentiment is constructive, and it offers clean technical patterns that are suitable for range trading. Hashtag 5.3, process for microcaps, the non-TKIF names. This section is paramount. While the liquid large caps provide reliable technical setups, the AHM, QTTB, and DRCP names are where the T-Kype system often finds its maximum edge because of that immense range.
But they require a fundamentally different process due to the extreme risk.
A completely different process.
So how do we apply risk management to something that is basically a high beta lottery ticket, like AHMA, which gapped up 235%?
The process for an extreme gap runner like AHMA is not based on moving averages or VWAP. It's based purely on momentum and structure. You have to watch for 10% to 20% intraday pullbacks from the morning high.
So you're buying the initial panic after the first wave of retail exhaustion.
Exactly. And crucially, your stop must be percentage-based and tight 5% to 10% below your entry. You are targeting the retest of the prior intraday or pre-market high. This has to be viewed as a scalp. Do not let it turn into an investment.
Okay. What process is appropriate for DRCT, direct digital holdings, the low-price vehicle with 282 million shares of volume?
DRCT requires scalping logic applied to extreme liquidity. The objective is small percentage edges captured quickly, relying on the stock's immense liquidity and tight inside market to manage slippage.
And because these stocks are low-priced and prone to sudden catastrophic news gaps,
hard stops are absolutely non-negotiable. If you size it appropriately, you can use the volume to your advantage for fast entries and fast exits.
finally, a volatile biotech play like Kala Bio, which often moves on binary news.
For Kala, you look for range compression after the initial spike or volatility event. Watch for the candles to narrow and the volume to fade. That often sets the stage for a secondary follow-through momentum move.
And tactically,
Since biotech is inherently volatile and prone to whipsaws, the tactical adjustment is to use a smaller size, but potentially allow a slightly wider percentage stop, maybe 1.25% to 1.5%, to account for the noise while you're hunting for that 1.5% range expansion.
so the core lesson is, use the public market data, the gainers, the volume, the IV spikes, as the funnel to identify the best prospects, and then apply the T-Kyfe standardized risk parameters to the specific technical setup that stock's unique volatility profile requires.
That process is the key. It's the key to maintaining discipline while maximizing the edge that is inherent in these volatile movements. #Tag6, closing synthesis and forward look.
All right, let's synthesize the core insights from the December 1st market action. The positive structural signals are there, but that narrowness of the leadership, it has to be constantly respected.
We confirm the constructive breadth signals. Advancers outpaced decliners, and new highs outnumbered new lows. The environment supports risk-on behavior.
However,
The leadership remains heavily concentrated. Technology, communication services, and consumer discretionary are leading. Energy and utilities are lagging. This means the overall market is relying on a shrinking core of high-growth sectors.
which brings us back to the operational reality. Since we can't access your proprietary T-Kyfe sheets, let's firmly anchor the 3 crucial operational steps. You, the listener, must execute locally to translate this deep dive into actionable trades.
This process will ensure you operationalize this market analysis seamlessly. So first, you need to immediately cross-filter the T-Kyfe universe. Take your entire universe of stocks and filter it using the public lists we identified today, the most active, top gainers, losers, and the pre-market movers. This instantly reduces the noise and focuses your attention only on the tickers that are demonstrably in play for range expansion.
And second, once you have that filtered list of high potential names,
Second, you must sort that filtered list using your proprietary T-Kyfe metrics. Specifically, your own measured average true range, or ATR, your spread quality, and your calculated target ranges. This ranks the potential trades based on their inherent suitability for your system, maximizing your hit rate.
and the final non-negotiable step before you execute.
The third step is to attach your T-Kyfe calculated entry bands and stop zones. Use the precise proprietary numbers from your local sheets. By aligning publicly observed activity, like volume and range, with your system's defined risk-reward metrics, you ensure maximum tactical precision and minimize your reliance on subjective judgment.
Okay, so what are the key tactical levels for the broader indices we need to watch tomorrow, given Monday's massive reversal and strong close?
For the S&P 500, the environment remains decisively bullish if tomorrow's session holds above the crucial Monday VWAP. A drop below that average price would signal institutional unloading.
And a breakout.
A clean breakout above recent swing highs with volume would confirm the risk-on move and set up ideal exit conditions for your Wednesday T-Kyfe trades.
And the VIX. Does it stay supportive of this short horizon strategy?
As long as the VIX stays contained in the low to mid-teens, below 18, the environment favors short horizon, tight risk trades. This range suggests confidence in the ability of the megacaps to hold the line.
But a quick spike in the VIX above 18.
That would signal an immediate need to reduce size across the board, or maybe even skip marginal setups entirely, as the structural risk would be increasing rapidly.
This detailed analysis from the reserve of KING-KAMBUF Financial News and Reports magazine really provides the necessary framework to navigate this top-heavy, volatile market successfully.
The core insight is that Monday's early dip was just a technical event. It was a brief, profit-taking moment before the relentless structural AI and tech momentum just reasserted itself. You have the process, you have the candidates, and now you execute the TKIF discipline.
This level of analysis brings us back to that central structural tension we discussed, that profound index concentration versus the low fear gauge.
Exactly. We noted that information technology makes up 35% of the S&P 500, and the top 10 names account for nearly 40% of the index cap. Meanwhile, the VIX, the market's proxy for fear, remains stubbornly low in the mid-teens.
Which raises a crucial question for you to consider tonight as you set your trade parameters.
Does the low VIX truly reflect overall market stability, or does it simply reflect institutional certainty, a profound conviction about the continued outperformance and dominance of the top 10 megacaps, potentially masking severe volatility and systemic risk underneath for the other 90% of the market?
That structural imbalance is the key to both the market's stability and its future fragility. Something profound to mull over as you finalize those highly disciplined TKIF entries for Tuesday morning. Thank you for diving into the daily report with us.
Analyze, cross-reference, and trade safe. We look forward to reviewing the next market report with you.